Let me begin, Robert Kaplan, with the idea of why you're in Mexico City. You and I know the research heritage of your Dallas Fed, of our southern border. Did you have to climb a wall to get to Mexico City today?
No, didn't need to climb a wall at all. No, we have a very long-standing relationship at the Dallas Fed with the Central Bank of Mexico and with senior government officials of Mexico. So I come here regularly, and officials from Mexico come to the 11th District regularly. But this is a very important relationship.
Yes.
Texas is the largest exporting state in the country, and Mexico is our largest trading partner.
Have your good PhD, the legendary Dallas team, the PhDs there, have they quantified what a Trump wall would mean to the GDP of Mexico or to Texas and the 11th District, or for that matter, to America?
Well, let me state it more positively. What I'd say the two key points are. One, the trading relationship between the United States and Mexico, I think in our research at the Dallas Fed shows, is very critical to competitiveness of the United States. And what do I mean by that? 70% of the goods that are imported from Mexico to the United States are what are referred to as intermediate goods, meaning they're goods that go back and forth across the border as part of integrated supply chains and logistical arrangements. And further, 40% of the content of U.S. imports from Mexico is U.S. content.
Right.
So this is a very different trade relationship than, say, the relationship with China, which is primarily or heavily final goods. This relationship has allowed U.S. companies to be more competitive in their manufacturing. It's allowed us to grow jobs in the United States. And if we didn't have this trading relationship, we would likely lose those jobs elsewhere in the world, probably to Asia.
President Kaplan, you know I've got a great team here at Bloomberg helping me out, making me smarter on this Friday. Let me begin with Michael McKee on NAFTA. What does Robert Kaplan need out of new NAFTA negotiations?
Well, as a central banker, I'm going to be careful about not commenting on a specific trade negotiation.
Right. Okay, fair.
Other than to say I'm optimistic. In talking to parties on both sides, I'd be optimistic that the importance of this trading relationship and the fact that it's much more of a strategic supply chain, sophisticated logistical relationship, I think that's being appreciated. And I'm actually optimistic, relatively optimistic and hopeful, and people in Mexico are too, that this agreement will be renegotiated in a successful way. We
just heard testimony from your boss, Chair Yellen, in Washington. Help me with the word transitory. Arjana Smilak is looking at transitory. Rob Kaplan, I've got a definition back to 1374 in Chaucer. I want to know Kaplan's definition of transitory inflation, and is that disinflation, rather, and is that going to end at 8:30 this morning?
Well, there's two parts of this inflation question. Number one, as your viewers know, at 4.4% unemployment and relatively low amount of labor slack, and I look, by the way, at U6, which is the unemployed plus discouraged workers plus people working part-time for economic reasons, and that's still not far away from the pre-recession low. It's 8.6%. At that low level of unemployment, you would historically have seen more inflation pressures. We're not so far. March was weak. April and May were a little stronger, and I believe strongly that some of this is transitory, meaning there's some one-time factors in the March numbers, but I think some of it is not transitory. Technology-enabled disruption, the fact that workers are being replaced by technology, that shoppers can use technology and have much more pricing power. I think businesses have far less pricing power right now than any time in my lifetime. And I think because of that phenomena, as well as to some extent globalization, in that goods and services are being to some extent competed for globally, I think we need to accept that some of this muted inflation is the fact we're in a different kind of economy than we were in 5 years ago, 10 years ago, and 15 years ago.
That's brilliant. That's a Kaplan distinction. Let's go right to that. The pricing power issue. Is this a different pricing power battle than the one that made Jack Welch famous years ago at General Electric?
It's dramatically different, and the reason for that is The rate of disruption, and let me explain what disruption is.
Please.
New business models being replaced by more efficient models that are technology enabled. And you go right down the list. The film industry, Kodak and Polaroid being replaced by the digital phone. Retailers being displaced by Amazon. Uber displacing taxis. It goes on and on and on and on.
Right.
And because of that, businesses, even if they have wage pressure, which I think there will be more wage pressure in the months ahead, it is much harder for them to pass that on to consumer, because consumers have far more choices, and traditional business models are being supplanted at a rate I haven't seen in my lifetime by new business models that are cheaper and better value for the consumer, and I think that's having a real effect on inflation.
If you're just joining us, Robert Kaplan joining us, Robert Kaplan of the Dallas Fed on Bloomberg Radio, Bloomberg Television, worldwide. Okay, I said Michael. Michael Dell's one of your constituents in Austin, Texas. You say Michael Dell's going to see wage growth. When's he going to see it?
I think we're already, I got to tell you, in my conversations with business leaders throughout the 11th District and throughout the country, and in our surveys, we're already seeing wage pressure for skilled workers, but we're now starting to see more wage pressure for unskilled workers. Companies I talk to talk about the term churn. Workers are leaving, unskilled workers are leaving for higher wages, and they realize they're going to have to pay more to keep those workers. And so I think with a lag, you're going to start to see more wage pressure, I believe, in the months ahead. And we're seeing labor shortages, I should say, across industries, but now increasingly for unskilled workers. And so that makes me think we're going to see more wage pressure.
Robert Kaplan, I think you and John Williams out in San Francisco are acutely attuned to currency dynamics. When you and I were at the Council on Foreign Relations weeks ago, you had beautiful analysis of the timeline of rate movements versus balance sheet movements. Our Carl Riccadonna is focused on the dollar dynamics of unloading that balance sheet. Do we care about currency movements when we finally taper to this and taper to that?
Yes, sure. We certainly, currencies and the dollar strength or weakness is something we watch carefully. Listen, I'm sitting right now in a country that's had enormous currency volatility, and that has spurred inflation here. And the central bank in Mexico has had to raise rates literally 10 times over the last number of months. And so a very weak currency or very volatile currency can have an effect. My own judgment, though, on the balance sheet unwind in the United States, I think we've designed it to be done gradually and in a way that is phased in, that I believe I believe and I expect it will have a minimal impact on the Treasury and mortgage-backed securities markets. But we've designed it that way to be very slow, gradual, so it minimizes the disruption to those markets.
Robert Kaplan, I've never done this. I'm going to do it now with you, and I know you're going to say I don't want to answer that, but you've got to. You are more qualified than anyone in the history of the Federal Reserve System going back to 1917 to talk about leadership and transition. Your classic book, What to Ask the Person in the Mirror. You had a beautiful thing for HBR years ago called The Pledge. Advise our politicians how they get to June of next year with the presumed retirements of Chair Yellen. I know you're going to say we don't know that. Or Vice Chairman Fisher. I know you're going to say we don't know that. In empty governor seats. What's the best practice for the politicians in Washington to get to a good and better Fed in 2019?
So you're right. I won't comment on potential candidates and the prospects of that happening. But I will say that. But I will say this: there are two major qualities I would highlight in a Fed chair, a Fed governor, or even a Fed president. But certainly in a Fed chair. Number one, the person, he or she, must be a respected and expert person that can analyze the economy and have views on monetary policy that are respected. They have to be able to stand on their own 2 feet in that regard and be respected. And the reason that's so critical is the second part of the job, which is they've got to be able to mobilize a consensus, forge a consensus among presidents and governors. And it's much easier to do that if you have interpersonal skills and people skills, but it's much easier to do that if you're respected in your own views, it's much easier to forge a consensus. And I think the next chair needs to have those two qualities. I believe Janet Yellen does have those qualities, and if there's a replacement, the replacement needs to have those qualities.
We have an eclectic Fed. I think of Richard Fisher with his unique work at the Dallas Fed before Robert Kaplan. I think of others over the years, Mr. Warsh and others. We have Mr. Quarles being appointed, and I know you're not going to talk about other names. How crucial is it to have a monetary PhD, a la Chair Yellen, a la Bill Dudley, and certainly a la the giant Stanley Fischer? How important is it to have a monetary PhD within that triumvirate of a chairman and two vice chairmen?
I think having very strong, grounded PhD skills, and I'm speaking now as someone who's not a PhD, by the way, as you know. I'm not even an economist. I'm a business person.
Some people would suggest that's an advantage, Robert. Somebody would say that's an advantage, Robert Kaplan. He's flying back from France right now.
Okay. So I would say you need to have some number of people with PhD, strong technical fundamental skills. And then I do think you need some number of people around the table that have a different background, business background, and I think the combination of those two is very, very powerful. And so I won't go so far as to say which seats, which need to have which skills, but I think as long as you've got a mix and you've got a leader that is good at organizing and orchestrating that mix, I think the Fed should and does work and will work very effectively.
President, one final question, if I may. Is this a fully employed America?
Is this a what? I didn't catch the word.
Is this a fully employed America?
I'd say it's an America that's getting very close to being fully employed. I mentioned U6 earlier. The pre-recession low was 8.1% in unemployment plus discouraged workers plus people working part-time for economic reasons. I prefer that measure over the headline unemployment rate because I think it's a measure. 8.1% was the pre-recession low. We're at 8.6% right now. That tells me if we're not at full employment, we're moving close to getting at full employment. So I think the Fed is getting very close to meeting its full employment mandate. I'm not sure we're there yet, but I think we're moving toward getting there.